Here's something that feels completely obvious. Debt is bad. So the faster you pay it off, the better. Extra payment on the mortgage every month, throw your bonus at the principal, maybe even refinance to a shorter term just to be done with it sooner. And for a lot of people, that feels like the responsible move, the adult move, the I'm finally getting my life together move. But here's the thing nobody tells you. For a big chunk of homeowners, aggressively paying off a mortgage early is actually one of the worst financial moves they can make. Not because debt is good, but because of what that extra money could have been doing instead. So today, I want to walk you through the math that most people never actually run, and why the answer isn't pay it off or don't. It's way more specific than that. My name's Jordan. If you've ever thrown extra money at your mortgage and just assumed it was the smart move, stick around, because this might change how you think about it. All right, let's start with why this even feels like a hard question.
Most people were raised with the idea that debt equals danger. Pay it down, get rid of it, sleep better at night. And emotionally, that's completely valid. There's real peace of mind in owning your home outright. I'm not going to argue with that feeling. But here's where it gets really interesting. A mortgage isn't just debt. It's debt with a fixed, locked-in interest rate, often one of the lowest interest rates you will ever have access to in your entire life. Think about it like this. If you locked in a mortgage at 3.5% a few years back, that's not just a bill. That's essentially a loan the bank is giving you at a rate lower than inflation has run in some recent years. In real terms, in some of those years, the bank was almost paying you to hold that debt. So the real question isn't, should I get rid of debt? It's, does it make sense to prioritize paying off cheap debt over investing that same money somewhere it could grow faster?
Let's put real numbers on it. Say you have a $300,000 mortgage at 3.5% interest with 25 years remaining. You get a bonus, or you free up an extra $500 a month, and you decide to throw it at the principal. Over time, that extra $500 a month will save you a meaningful chunk in interest and shave years off your loan. Let's say roughly $95,000 in interest saved, and about 9 years off the loan. That sounds fantastic. But here's the crazy part. If you took that same $500 a month and invested it instead in a simple diversified index fund averaging a historical 8% annual return, over that same 25-year period, that money grows to somewhere around $475,000. Read that again. $95,000 saved versus $475,000 grown. That's not a small gap. That's the difference between paying off debt early and potentially having nearly $500,000 more by the time you're actually done.
Now, you might be thinking, okay, Jordan, but the market doesn't guarantee 8%. What if it crashes? And that's a completely fair pushback. This is where the math actually gets nuanced. Not just invest everything, mortgage doesn't matter. Here's the real calculation you need to run. It's called the interest rate spread. Take your mortgage rate, compare it to a realistic, conservative long-term investment return. If your mortgage is at 3.5% and long-term market averages historically land somewhere around 7 to 8%, there's a meaningful spread in favor of investing. But if your mortgage is at 7%, which a lot of people locked in more recently, that spread shrinks dramatically, or even flips. At that rate, paying down the mortgage might genuinely be the better math. This is the piece almost nobody calculates before deciding. They just default to pay off debt as a blanket rule, without checking whether their specific interest rate actually makes that the smart move. Now, here's the part where psychology sneaks back in, because this isn't purely a math problem.
Even when the math favors investing, some people will still sleep better having a paid-off house. And here's the thing. That's not irrational. There's real value in reducing your monthly obligations, especially if your income isn't perfectly stable, or if the idea of market volatility genuinely keeps you up at night. A guaranteed return, even a modest one, is worth something that a bigger but uncertain return isn't always worth to every person. But the mistake is treating that emotional preference as if it were a mathematical fact. It's not. It's a trade-off, and you should at least know what you're trading away before you make that choice. So let's talk about who this actually applies to, because I don't want this to sound like blanket advice either. If your mortgage rate is low, anything under roughly 4 to 5%, and you don't have higher interest debt sitting elsewhere, and you're already contributing enough to retirement accounts to get any employer match, the math very often favors investing extra money instead of prepaying the mortgage. That spread between your mortgage rate and expected investment returns is usually working in your favor. If your mortgage rate is high, 6, 7, 8% or more, the math shifts. At that point, paying extra toward the mortgage is closer to a guaranteed return equal to your interest rate, which starts to look genuinely competitive with average market returns, without the volatility. And if you're carrying high interest debt somewhere else, credit cards, personal loans, none of this applies yet. Pay that off first. It's not even close. No mortgage math competes with an earned 22% credit card rate. Now, here's something most people don't realize about the psychological trap hiding in paying off the mortgage early. Once that money goes into your house, it becomes what's called illiquid. You can't easily get it back out without selling your home or taking out a new loan against it. Every extra dollar you throw at your mortgage is a dollar that's now locked inside your walls, literally, instead of sitting somewhere flexible where you could access it in an emergency. Compare that to money sitting in an investment account. It's not perfectly liquid either, but it's a lot closer. You can sell shares. You can access it in a genuine emergency. Money paid into your mortgage principal doesn't work that way. The bank doesn't hand it back just because you suddenly need it. So there's a real liquidity cost to aggressive mortgage payoff that almost never gets factored into the decision. Let's bring this back to something practical, because I don't want to leave you with just theory. Here's a simple framework. First, check your mortgage rate against realistic long-term investment returns. If there's a meaningful spread in your favor, several percentage points, lean toward investing extra money instead of prepaying. Second, make sure you have an emergency fund and you're capturing any employer retirement match before doing either. Third, if the idea of extra debt genuinely affects your mental health or your sleep, it's completely fine to weight that into the decision. Just be honest that you're choosing peace of mind over pure math, not confusing the two. And fourth, you don't have to pick one extreme. A lot of people split the difference. Some extra toward the mortgage, some into investments. You don't need an all or nothing answer to get most of the benefit. Because here's the actual lesson underneath all of this. Paying off debt fast isn't automatically responsible, and investing instead of paying off debt isn't automatically reckless. The right answer depends entirely on the specific numbers in your specific situation, your interest rate, your timeline, your risk tolerance, and what actually lets you sleep at night. Most people never run this comparison. They just assume debt-free is always the goal, without checking whether the debt they're rushing to eliminate is actually expensive in the first place. So before you throw your next bonus at your mortgage, do the math first. Compare your rate to realistic investment returns. Because sometimes the responsible feeling choice and the mathematically optimal choice are the same thing. And sometimes they're not even close. If this changed how you're thinking about your own mortgage, hit subscribe and tell me in the comments, what's your mortgage rate? And does this math change what you're planning to do with extra cash? Because that one number might be worth more than any advice I could give you generically.